valuable panel member of the World of Startups talk series. Let me introduce about the talk series. The World of Startup talk series is intended to provide a platform to the innovators, startup founders, and the budding entrepreneurs to share, learn among the ecosystems and get connected with the right mentors, investors, and try to resolve the certain areas and the questions which they are facing day to day in their life. We are connected with bunch of mentors across the world who came forward and supports and guides these all the entrepreneurs. So to all the audience, let me introduce today's panel. So we are going to have a panel discussion on what investors are looking forward before they invest into the startups. And on our today's panel, we have with us Dr. Ganpat Bhai Patel. Ganpat Bhai Patel is also known as a Pet Patel and widely known as Dada among the students and staffs of Ganpat University. Dada is an Indian and American high-tech entrepreneur, businessman, and philanthropist. Dada is also the founder of Cherokee International and has been president and CEO before retiring. Dada is also the president and Patron-in-Chief of Ganpat University and recognized professionally for his contributions to the field of electrical engineering and personally for his philanthropy. So far, Dada has generously donated more than 100 crores for the cause of education. He has been awarded with numerous of achievements and awards, and the list is too big. But recently, he has been honored and conferred with one of the highest civilian honor from Government of India, which is a Padma Shri 2019. Dada personally promotes startups and entrepreneurship culture among the university and personally guiding, mentoring, and investing into many startups. He believes that the youth should be a job giver than the job seeker. His journey over the unpaved road throughout his life has motivated and guided millions of people's life across the world. We thank you, Dada, for joining us today to guide the young innovators. We also have thank you, Dada. We also have us today our distinguished speaker and one of the panel member, Shri Ketan Bhai Patel. Shri Ketan Bhai Patel is an investment catalyst, venture capital investor, and has mentoring so many startups and guiding them in the field of security, IoT, mobile wireless technology, AI, ML, media, SaaS, fund formation management, investment risk assessment, and was worked as a Nexstar partner in New Jersey from 2014 to 2018, which is a $100 million early growth venture capital fund focused on the living network and inventing recasting of mobile network as a dynamic entity leading to the unique insights into investment challenges and opportunities. He worked as a founder and managing director as a Nexstar partner. Adding to his professional achievements, he worked as a principal partner, New Venture Partners, New Jersey from 2006 to 2014, and has worked as a product management, technical sales, application engineer, again in California, and carries vast experience in the field of startup ecosystem. And currently, Ketan sir is also actively supporting and mentoring few of our startups at Ganpat University and helping us in cross-border association with American startups to get connected with Indian ecosystem. Thank you, Ketan Bhai, for being with us today.
Thank you, Dr. Dubey, and good evening, everyone.
Good evening, sir. We have with us Mr. Mayank Patel. Mr. Mayank Patel carries more than 9 years of experience in banking and financial services and has completed 12 years as an academician and business incubation professional. He has also received CFA Chartered from CFA Institute, USA. His academic interests are financial markets, asset pricing, behavioral finance, risk management, and quantitative methods. He specializes in the area of fintech, investment research, corporate finance, and financial derivatives. He has presented a numerous of papers during various conferences and has also attended workshops on econometric and computational finance. He is a keen follower of political economy and development in the field of education. He is currently working as a JG University as an associate professor. Mr. Mayank Patel is also an active member of Gujarat Startup Ecosystem. He is a curator, mentor, guide, and one of the panel member at Government of Gujarat who reviews and supports the startup at raising the early seed grant for their prototype. Thank you, Mayank Bhai, for joining us today.
Thank you for inviting me to this discussion forum.
Thank you, sir. So this will be more of an interactive panel discussion, and we'll be starting asking the questions to the panel. I request all the attendees to also ask the questions into chat board or question and answer section here, and we'll be taking care of all those questions. So my first questions to the panel member, Mr. Ketan Patel. How do you identify the startups for investment in line with your portfolio? Sir.
Yeah, thank you, Dr. Dave. So let me clarify a little bit about kind of the investment activity that I've been involved with. When I started Nexstar Partners and when I was running Nexstar Partners, most of our investments were focused on what's called early growth investments. So typically that means companies that we're investing in were generally recognizing and realizing revenues in anywhere between say 2.5 to 5 million already. So typically a lot of the early stage development and the early risk associated with investing in technology companies had already been done. And what we were doing was providing growth capital in order to accelerate the revenue traction, the customer traction, and the market traction. That's one context. Before that, when I was a partner at New Venture Partners, we were effectively the first institutional money into a startup. And what that means is that we were typically the first funding source. We were writing the first check in the startup. So generally we were working with really early stage entrepreneurs or engineers and helping them formulate a business plan, help them formulate a financing plan in order to help them realize kind of the overall entrepreneurial journey. And I bring this up because depending on what stage the startup is in, the way you go about assessing what are interesting startups and what are not interesting startups is dramatically different. Typically in the early stage, what I used to do when I was at New Venture Partners, what you were really looking for, and the way we were going about identifying these entrepreneurs was, we were looking at the overall market, trying to understand the market landscape, trying to understand where are there growth opportunities or investment opportunities in the context of how the market itself is evolving. And in that case, what you're doing is you're looking at the market as it stands today, and you're trying to project what the growth of the market is going to be 5, 6, 10 years out, and trying to understand, how does the technology that's being developed within the context of the solution that the startup is bringing, how is that going to intersect with the market growth trajectory at some point in the future? Contrast that to what we were doing at Nexstar Partners. At Nexstar Partners, we were really looking at the market in a very different way. We were looking at not necessarily the future potential of the market. We were looking at what was happening in the market currently. We were looking at something that was much more near term, maybe 3 to 5 years as opposed to 5 to 10 years out. And in that particular instance, what we were doing is that we were looking for, we were really looking for, what's the word I'm looking, how does the current technology address the current market needs? So in the former case, we were looking at, what is the growth trajectory of the market long term? And then in the latter case, we were looking at, hey, look, there's a market need that exists today. How does the particular solution for the startup fit that market need in the near term?
Great, great. Another question goes to Dada.
Yes.
Dada, the question is, from the investor's view, what are the advantages of investing in these startups at a very early stage?
Well, from investor point of view,
Yeah.
so investors have many reasons. There are venture capitals, there are angel investors, and there are people like me who are retired but have a passion for certain things. So the angel investors are the investors that are usually they invest as a seed money, like Ketan Bhai said. They are the early investors, and they also have a passion for certain things. They have already made it in life, and because it is something coincides with their own interest, they would invest, and they are somewhat of a risk taker because they are probably a self-made millionaire. The venture capital are the one that are, as an entrepreneur or a startup, I would be very careful of them. They want to own you as early as they can. And if they own you, then they have taken away your drive. So if you don't need them, don't use them. Angel investors are a lot easier to work with because they themselves have gone through, so they understand the problems of the startups. Startups has a many problems, but one of the biggest problems that I have seen with the many startups is they go to raise money too soon. And the second biggest problem is they promise more than they can deliver. They overpromise and underdeliver, and then that starts the friction, and it is no more a startup; it's a failure. So, all my startup friends, I want you to. I personally started my business in my garage. I had a better mousetrap than anybody else. I had a mousetrap that I could charge whatever I wanted to charge because nothing like that was available in the market. So I was a self-finance. I had never, ever gone to bank in my life until now. Never. I've never borrowed money. It was a bootstrap from the profit, and my profit was 500% right from the day one. And it always stayed that way because I kept ahead of the technology. So as a startup, if you can do it from the sweat equity, your own creation, then do it. I wouldn't go for money if I don't need it. It should be absolutely the last resort. Most of the startup, when they go out for financing, they are wasting more time trying to get a little money, and they are busy answering questions to the investors, and whether it's an angel investor or venture capital or whoever it is, or relatives. So if you have idea, spend 100% of your time pursuing the idea. Try to live on a lean and mean in the beginning, which will require less and less money from whatever the sources are. And then if you want to go out for absolutely minimum money and give up minimum control of the company. Because once somebody owes you more than 51%, they have taken away all your drives and your interest and everything else. And it's a beginning of the disaster. Thank you.
Thank you.
Dr. Dave, can I add something?
Yeah, please, sir.
Yeah.
Sorry. So I think what Dada said is absolutely right. To all of the participants that are listening, if you don't need the money, please don't take the money from anybody. Kind of using your own and using self-financing and kind of growing the company. By the way, I am a venture capital investor. I made my business and I do my business in trying to invest in people who want money. Okay. So please understand that I know I'm contradicting my own self, but he's absolutely right. And the reason for it is if you come to me as an entrepreneur at some point in the future and say, hey, Ketan, I've invested, my sweat equity and I've been able to grow the company to 3, 4, 5 million in revenue. That to me is a significant validation that one, you're very serious about being an entrepreneur. Two, that you're very serious about growing a very successful company. And three, that you figured out how to be an entrepreneur. So for me, who's a funding source and somebody that has a venture capital fund that could potentially scale and help you build and grow the company, it becomes a no-brainer activity. It becomes very easy for me to go out and support whatever growth endeavors that you have. Now, here's where I will actually provide a little bit of a contrasting view to what Dada just said, which is typically venture capitalists will go out and invest. They don't want to kind of own the company. It's very rare to find a VC that's going to own more than, say, 25 or 30% of the company. But I think what you have to be careful about is that VCs are going to want to manage your company.
I should say control, not own. Yes.
Right. Yeah. So what we want to do is we want to control the direction and the strategy. And we do that by basically taking and influencing the board decisions.
Right.
So we're happy to share in the economics with the entrepreneur, and the entrepreneur will own the vast majority of the shares in the company. But the decisioning on kind of what the strategy is for the company going forward then becomes a shared responsibility.
Yeah. Great. Thank you. Thank you for topping up. Just to bring into the notice of the honorable panel members, we have today an attendees from grade 4, Saurabh Purohit. So from the early age as a kid, he's looking forward to start his own business in the field of chocolate. So the encouragement among today's young entrepreneur, and they are coming forward to take the ownership and start their own business while they are studying. So from that to we have participants from across the India in today's panel discussion. My next question goes to Mr. Mayank Patel. What are the aspects, sir, we are looking forward for risk analysis before we invest into the startups?
Generally, the risk analysis depends first on looking at the people behind the startup, the team that is coming up with the technology innovation idea. The second is the market, the size of the market and the potential that the startup can capture. And third is the technology risk among the competition. So a startup is suggesting a solution through a unique innovative technology, and the same solution can be suggested by other startups also, other technologies also. So we have to see what is unique, what is competitively preferable, advantageous for a particular startup. And if there is a mistake, or let's say if there is a failure in looking at in the correct direction on these three parameters, there is a risk for investment. So risk analysis, I believe, it depends on these three factors.
Great. Thank you. Thank you, sir. My question goes to Ketan Bhai. How we do the research before we invest into these startups?
Yeah, that's a good question. And before I answer that question, to the young man that's about to start a chocolates business, I highly encourage you to do so. I'm very much reminded of my niece. My niece loves to bake cookies, and she started her own business baking cookies and baked goods. Unicorn Cupcakes is the name, and you can look it up online. Unfortunately, they're only available in the United States, but she took a passion that she had of baking, and my niece is 7 years old. And she really loves to bake, and she loves to make cookies, and she started a business, and it's doing well. She started by selling to friends and family, and eventually word got out, and it got around to the social community. It got around to the school that she goes to, and it's kind of the spread. So it's become a kind of a very interesting kind of a little business for her, where she's learning a lot about how to be an entrepreneur, and I think it's going to give her some valuable life lessons. But back to the question that you asked me. The question that you asked is, how do we go about doing the research? Look, due diligence from an investor perspective is very, very, very important. And what I mean by due diligence is that what we're looking at when we do due diligence is the full scope of diligence on the particular company. We are looking at everything from what is the market doing? How does the company fit into the market? We're looking at things around the quality of the technology. It's not unheard of for investors to basically ask for and get a technical level detail of what the technology is. If it's hardware, we want to see what the designs of the hardware look like. If it's software, we want to see what the source code of the software is. It's possible that we may bring in a third party to help review the source code and trying to understand the quality of the source code that exists. We're looking at legal due diligence. In legal due diligence, we're looking at everything from, what is the company formation? How is the company formed? In the United States, you can form your company in a lot of different ways. You can set it up as a limited liability corporation, an LLC. You can set it up as a partnership. You can set it up as a C Corp, as an S Corp. Where is the company domiciled? Is it domiciled in the United States? Is it in India? Is it somewhere offshore in Mauritius, for example? Or is it in the Cayman Islands? We're looking at the governance model. Who owns what percentage of the company? We're looking at the prior funding history. Are there any terms in the prior funding that the company has taken on that could prevent the company from raising funding subsequently? To give you an example, a lot of times what we find is that I alluded to the fact that, seed investors are very active. These are typically successful entrepreneurs who want to contribute back into the innovation ecosystem in some way. But a lot of times, a lot of the terms that they put into place have right of first refusal, or have a first exit priority on the company, or have a lot of these onerous and very difficult terms for the company to be able to raise subsequent rounds of financing. And for early stage entrepreneurs, it's easy to get attracted to the money that's available. Your life depends, your success depends so much on the money that's available, that a lot of times you fall under this idea that, hey, look, if I just get this money, I'll figure out the stuff later on. But unfortunately, the stuff that happens later on prevents you from getting anywhere further. So when we're doing diligence, we're doing a very, very exhaustive diligence in trying to understand where does the risk occur. And by the way, when we invest as investors, as professional investors, we understand that we're taking on risk. It's part of the game. It's part of what comes along. It's not that we're looking for an investment opportunity that's got zero risk. That doesn't exist. If it did, everybody and their brother would want to invest in that company. But the idea in doing the due diligence is trying to understand, where does the risk exist and what can we do in terms of how we structure our own investment to help mitigate or reduce that risk.
Yep.
And the final thing I want to share with you is that we do an extensive amount of diligence on the team. We want to understand what your educational background is. We want to understand what your professional background is. What kind of a professional reputation do you have? Who do you know that we can talk to get a better understanding of who you are? We want to understand your past successes. We want to understand your past failures. What have you learned from it? We're trying to understand what quality of an engineer you are, what quality of an entrepreneur you are, and what quality of a leader you are. By the way, all three of those are very, very different. You can be a great engineer, but you can be a lousy entrepreneur. You can be a great entrepreneur, but could be a lousy leader.
Right.
But in order to grow a complete company and be really successful, you kind of have to have all three dimensions, and you have to have all three of them in order to succeed. So if you are a startup and you're an entrepreneur and you start talking to an investor, you should expect anywhere from, I would say, 4 weeks to up to 8 weeks of continuous, ongoing, daily, persistent dialogue that's part of the due diligence process. If for whatever reason you're turned off by sharing any of that information, then you shouldn't be talking to investors. If you have something to hide, if your financial records are not up to date, if they have not been audited, then that's all of those things are going to be stumbling blocks when you start talking to investors. So diligence is critically important.
True. True. Thank you. It was really very much insightful. My questions to Mayank Bhai, how you look at the proof of concept or a solutions which is proposed to you? What you basically review the solution?
What we generally review in the solution is that can the solution, the proof of concept, be converted into a business model? Can the product or service be sold to someone who is ready to pay for it? Can money be made from that? That's the one part. Second thing is, what will it take to sell the product? How is the competitive scenario being placed? These are the few things that we look at when reviewing the proof of concept for investing, and sometimes also for incubation and mentoring. These are important things we consider from the perspective of long-term success or sustainable growth of the startup.
Thank you, Mayank Bhai. My questions to Dada from one of our attendee, Manali Rawal. She has asked us that according to you, what kind of a person makes successful entrepreneur?
Well, if you are an entrepreneur, you have a passion for something. But if you want to be a successful businessman, like Ketan says, you should be good at everything. That is managing, looking how to get along with people, how to treat people. If you have a selfish personality, you're not going to go too far. You should be a team creator and a team player. You should be a passionist, of course, goes without saying. But you have to be able to look at in people's eyes and say, okay, I'm going to solve your problem. When you are solving other people's problem, your problem is automatically solved. You are successful. So there are stages. There is one stage that is a entrepreneurship. When I started my business in the garage, I had no idea what was going to happen. But suddenly, my product had a demand, and I was able to sell for a lot of money. So I quickly learned how to manage. Creating a product is one thing, and then how to manage is another thing. And then as business grows, there are different steps. I was like my first $1 million sales, then $10 million, then a 25 million, and then 100 million, and then up to 500 million. So at different stages, you have to create a different environment in the company, and you should be, as a beginner, as a startup, you should be willing to empower the people and let go. Too many entrepreneurs, they cannot let go their baby, and so they cannot grow. You have to delegate. Early on, Steve Jobs had that problem, and then eventually he learned quickly. But that's what I would say to the beginner is be good at everything. You have to quickly learn how to manage yourself, how to manage others, and then you have to be good at managing money. You have to be good at managing time, your own time, accountability, transparency. These are important virtues.
Great. Thank you, Dada. Thank you. My question goes to Ketan Bhai. How do you differentiate between venture capital and angel investment?
Yeah, that's a good question. I mean, and Dada kind of alluded to this a little bit earlier.
Right.
It's kind of almost two sides of the same coin, to be honest with you. The key difference between an angel investor and a venture capital investor is, where's the source of money coming from? An angel investor is typically somebody that's investing out of their own pocket. It's a pool of money that they have that belongs to them. A venture capital investor is not investing out of their own pocket. The money that's invested and provided to a venture capital investor are provided by a third party. So that could be a university endowment, it could be a pension fund, it could be an insurance company, it could be a high net worth individual in a family office. So a venture fund is almost like a mutual fund in a sense. It pools capital together from a bunch of different sources. And then once it has that pool of capital available to it, then subsequently invests in startups, right? Whereas an angel investor is basically, I have a pool of capital that I want to invest, it's my money. It belongs to me and I'm just going to make investments on my own. And the key difference between the two is that the incentives are aligned very differently between an angel investor and a venture capital investor. An angel investor is typically doing it because they feel they get some personal benefit, whether it's some economic benefit or some social benefit from investing in these startups. An institutional investor, a professional investor, a venture capital investor is a money manager, okay? And what you have to realize about that is that, and kind of Dada alluded to this, is their responsibility is not necessarily to the startup. Again, keep in mind, folks, I'm a venture capital investor. I've spent my vast majority of my career as a venture capital investor. I invest in startup companies. I want to see my startup companies do well. But my responsibility is not to the startup company. My responsibility is to my investors that have funded me. Okay? So the decisions that I make is always with the lens of, I have a responsibility. I have a fiduciary, in the United States, there's a term, it's a legal term called fiduciary obligation. That means that I have to put the interests of my investors first and foremost before putting the preferences of my portfolio companies. Okay, so what that means is when time comes where I have to decide on what's more important, I am legally bound because of my fiduciary responsibility to my limited partners to do what's right by them. And if that means that I have to stop supporting the entrepreneur, if that means that I have to stop supporting the startup and basically cut off funding, that's the unfortunate reality. Whereas an angel investor may say, hey, look, no, I still want to support this innovation. I still see the long-term potential in this particular individual. They're having a tough time. I don't, as a sole kind of an angel investor, I don't have that fiduciary responsibility because it's my own money. And as a result, I may continue to support the endeavors of that particular, that startup or that particular entrepreneur. So as I alluded to earlier, it's kind of, it's two sides of the same coin, but they're very different sides of the same coin. It's a pool of capital that's available for entrepreneurs to kind of use, but the entrepreneur has to think very, very selectively and has to be very careful into when to use angel investment and angel money versus venture capital funding.
Right, right. Thank you. Very great insights about the different funds and different source of the fund. My question goes to Mayank Bhai. How do you see the team before investing into these startups?
A team before investing.
Yeah.
Yep, I think this is one of the most important aspect. Ketan Bhai just mentioning one of his response to your question. That team is one of the critical thing. What generally mentors, incubation companies, or even angel investors and venture capital funds, they look for is what is the quality of the team? Does the team have sufficient diversity? Does the team come with fantastic background of knowledge of technology, education, experience in the field in which they are proposing the startup? And can the team work together for a long time? Many times startups fail because team members who founded the startup initially are no longer in a position to work together because of the personal differences, ego, or different preferences. But important thing is the team which is ready to work or has capabilities and attitude to work for long time together and has a diversity and has a background. Apparently, they also look. We also look generally that what the team has done so far. The startup may be new, but the team, the people proposing the startup is not new. What have they done? What are their achievements in academic, professional life? What have they learned from their earlier failures? And what kind of ambition they have? These are the important aspects related to team. I generally believe team is more important. People are more important than products or services or technology.
Yeah. Thank you, Mayank Bhai. So my question is to Ketan Bhai, how to gain people's interest in SaaS products? This is a question from one of our attendees today, Azim Shah.
Yeah, I would say that there's a lot of interest in the investment community when it comes to SaaS. And by the way, let me just say that, if you look at the trajectory and the history of what's actually happened to SaaS, 10 years ago, Salesforce kind of came onto the market. They were a replacement for Oracle. Oracle was an on-prem CRM and kind of customer management software package. And when Salesforce came on and basically said, hey, look, we can do a more efficient job of delivering this as a kind of a monthly subscription and kind of put it in the cloud, that was the trigger point for starting kind of this investment trend in SaaS. Okay. And I bring this up because about 10 years ago, SaaS in and of itself was a very new category.
Yeah.
Fast forward to today and kind of what's happening in the market today, SaaS is not an investment category. SaaS is now kind of the de facto. SaaS is effectively a means of addressing and delivering your product in the market these days. And a lot of that has to do with just the fact that, there's the migration to the cloud. Enterprises are moving more and more software into the cloud, and it's become just the de facto way of kind of buying software. It's a much more scalable, much more linear way of kind of thinking about addressing and kind of migrating their huge capital expenditure on the front end into an operating expense model. So having said all of that, there are a class of investors about 10 years ago that wanted to differentiate themselves and say that they were a SaaS investor. I think now it's kind of morphed into not necessarily being a SaaS investor, but it's morphed into more just being a delivery mechanism for enterprise software. So the question is, how do I get attention for my SaaS company? One, I wouldn't call it a SaaS company because SaaS is just basically a delivery mechanism. SaaS has become kind of the de facto norm in how you deliver software. Instead, I would ask that individual to think about what is the enterprise software that they're building? What is the enterprise problem that they're trying to address? And kind of think about the business strategy from the perspective of trying to deliver something into the end.
Yeah. So the question is to you, Ketan Bhai. How do you see the future of the future technology-based startups like blockchain? Can they attract the business and the investment both?
So it's another very good question. Basically, blockchain is also a technology domain that's actually become very, very interesting, and it's got a lot of attraction. I myself, in my last fund, basically made an investment in blockchain. Here again, you have to be very careful about what you mean by blockchain. There's two different portions of blockchain. There's the blockchain protocol itself. And then when people refer to blockchain, all too often, they also refer to the cryptocurrency aspect of blockchain. Okay. Yeah. So let's differentiate between the two. Cryptocurrency, there is a lot of investment interest there, but a lot of investment interest is now coming from a lot of the large financial institutions because cryptocurrency has become an individual asset class in and of itself. I personally have my opinion on kind of whether or not cryptocurrency is sustainable because I think over time, it's become so speculative right now that there's no correlation to kind of how the overall financial markets are moving. So it's become a completely uncorrelated asset in and of itself that kind of bounces around in price independent of what's happening with the broader economy. So I have some concerns around that. But if you're talking about blockchain as a protocol, and I made an investment in a blockchain company that was using the Hyperledger or the distributed ledger protocol in order to address a security need in the IoT space. So IoT, you have a bunch of distributed devices. There's no way for you to go ahead and have a centralized security offering. The Hyperledger and the distributed nature of the Hyperledger in and of itself is conducive for a distributed environment where these distributed endpoints reside. That was a use case where they were using the blockchain protocol more for enterprise software applications. There is a tremendous amount of interest for using blockchain for real world use cases, for distributed compute, distributed security, for IoT, for network edge type of use cases. And I think that will sustain and that will continue for at least the next few years.
Thank you. Thank you, Ketan Bhai. Question goes to Mayank Bhai from Rishikesh. Rishikesh is asking that what is the ideal size of the team? Is there any golden formula?
There is no golden formula of ideal size of the team. What is required is what is the quality of the team rather than the number. One is the team having sufficient diversity of education background, experience, knowledge. Another thing is what has the team done? I'm just repeating what I have said earlier also. What are the achievements of the team in their previous work and academic career? So this is important rather than having, let's say, a 2-member team or 3-member team or 4-member team. There is a fantastic startup. I give you an example here, based in Netherlands. This startup had a 30-member founding team, and they won in Australia. There is a solar power car race every year being held, and this team from Eindhoven University won that race in one of the year, and then just come out with a venture called Lightyear Ventures. 30-member founding team, and not a single person is leader or controller or commander. Okay. So when I interacted with them through some intermediary, one question that I ask is, who is your leader? And the answer was, depending upon the question that needs to be solved, we have a leader in the team. Okay. No leader otherwise permanently. So there is the same thing. There is no ideal size, golden rule for the number of team members. It depends on the kind of problem that you want to solve, and can team member have the capabilities to bring an answer to that. That decides the team.
Great.
Thank you.
Thank you, Mayank Bhai. I think it has answered the Bagul's question. We have questions from Darshan Rupani. Ketan Bhai is asking that how to approach the investors to invest their money to our startup. I mean, what are the tips that would be helpful to us when we need funds for the startup?
Oh boy. So the reason why I say oh boy is because I don't think there's kind of a one definitive answer. And the reason why I say that is, I mean, so to the individual, let me just say this. Look, if you're trying to approach an investor, if you're trying to approach a venture capital fund, the best way to do so is do your research. Not every venture capital fund is the same. Different venture capital funds and firms have their own individual investment mandates. There's specific domains that they invest in, and there's specific stages that they invest in. Okay. So first step is to try to, take the landscape of all the venture funds that exist in India. Take a look at which ones are the ones who are open to doing investments at the specific stage that your company may be in, whether it's a seed stage, a Series A, Series B, Series C, etc.
Right.
Second, you need to understand is whether or not they're interested in your particular piece of technology. There are healthcare investors, there are consumer tech investors, there are enterprise tech investors. The other big tip I would say is that once you find a venture fund that you think is reasonably in your wheelhouse, that fits the criteria of your startup, it is very, very important for you to find the individual partner who is responsible for that particular investment thesis within that particular fund. So to give you an example, in my last fund, there were 4 of us who were investing. Each one of us had our own investment idea, our own investment sectors. I had team members on my team that were individually focused on IoT, another team member who was focused on security, another team member that was focused on media, another team member that was focused on SaaS and infrastructure. So, if you're a SaaS company and you go to the guy who's investing in security, he's not going to pay a lot of attention to you. So you have to make sure that you're targeting the individual person that you're going after. Once you find that person, it's critically important for you to find somebody who could be an introduction point for you. Randomly sending a blank email may or may not necessarily work. But if you can find somebody that's in your network that is either 1 degree or 2 degrees of separation away from you that can introduce you to that particular individual, that person is much more inclined to accept your meeting. And the fact that you have a reference point that they can go and reference you against because you have a mutual connection is critically important. So I would say, one, do your homework, make sure you're targeting the right firm and you're targeting the right partner within the firm. And then 2, try to look for a connection point that can help you introduce you into that particular individual. Beyond that, I would say, look, you need to have just all too often I come across entrepreneurs that have a really great technology, but the technology doesn't necessarily address any immediate or kind of a near-term market problem. Or I come across entrepreneurs who are building a really cool technology thinking that they can fit a particular technology into a market problem later on. As an early stage investor, I think what you really need to do is you need to convince the investor that the problem you're trying to address is a really big problem. It has a tremendous amount of economic value in trying to address that problem. And then if you can convince them that, hey, look, I'm the right guy who can go address that problem with my technology, then it becomes a very good fit. But if you start coming in and you start talking to me about how great your technology is and how great it's going to be built, and you use, Python and you use, this other scripting language to go out and do this, and it's got this bells and whistles and stuff, but you haven't convinced me that there's a really compelling market need, it's going to be the end of the conversation. Mm-hmm. So, again, let me just reiterate. 1, find the right firm, find the right partner, find an introduction, and then convince that partner that you've got a big market that you're going after.
Yeah. Thank you. It's a great suggestion. The another question is, what are the key points to be covered in the investment pitch?
Again, for me, Dr. Dave? Oh, yeah, look, I recommend the person who asked this question, I think there's Kleiner Perkins. If you go to the Kleiner Perkins is a big venture capital fund, very prominent, very successful. They've been around for many, many years. So if you go to the Kleiner Perkins website, Kleiner Perkins has a research section. Under the research section, they publish a template for what a startup pitch should be. Okay, I think that's a good starting point. And because I say that it's a good starting point, and by the way, the other one that I think that might be a good resource for people to use is the NVCA. In the United States, it's called the National Venture Capital Association. They provide a lot of free resources and tools that the entrepreneurs can use in order to help them think through kind of how do you develop a pitch? How do you think about the documents, the legal documents and stuff associated with a financing agreement. But the 2 of those are really good. The Kleiner Perkins pitch deck, I think, is really good. It starts with basically a really compelling story on a significant market need. It talks about the economic value of that particular market need. It talks about what a viable solution for that particular market need may be. And then it ends by talking about kind of why you have the right team to go out and build that particular solution that addresses that particular market need. The last dimension of it is the financial dimension, which talks about, how much money do you need? How are you going to plan on using that money? But I think, as a good starting point, I would say, take a look at that Kleiner Perkins pitch deck template. That's a good starting point, and try to leverage that and try to build your story.
Thank you.
Just to supplement Ketan Bhai's response, in India also, Indian Angel Network, one of the most prominent angel investor network, and Indian Venture Capital Association have their own templates, and they are available on their website also. Interested startup enthusiasts can look at those, download the templates and look at those templates while preparing their pitch to investors in India.
Okay, good.
Thank you. My question to Dada, what should startup look into investor apart from the money?
He should look at investor as from not only pure money. There are two kinds of money, dumb money and a smart money. He should look for a smart money where angel or venture capital or whoever the money man is, they should be adding more value than just money. They should have experience of doing it before, and just the same way the money people interview the entrepreneur also should interview the money people, and make sure that you are going to the right people to get the money, because sometimes there are easy money and a difficult money. People who has come easy money, and they're not very smart about investing, their expectation and your delivery does not match, and it will be a failure. So make sure that you look at for a genuine money, honest people who also can help you to grow, and they have passion, they have understanding of your problems as an entrepreneur. The reason I'm it's not my first choice to go out for money as a entrepreneur. It should be my last choice. I would go and explore all other avenues, and that's what I did. But it's not to say that you shouldn't. If you absolutely have to, you should. But Harvard Business School has run the study that there are three kinds of startup. The startup that has gone for money, they have very seldom survived and made it. The one that has started from sweat equity and grown from sweat equity and from within, they have been very often more successful. So go for the money, but make sure you find right people, people who are willing to understand your problem and have little. There are a lot of money people that are ruthless. I just want to warn you. And when I say ruthless, the venture capital in America, what they say, we say vulture capital. Vulture is a baj pakshi that eats everything. And I don't want to discourage you, and I'm not taking away your business, Ketan, from you. But I just want to make sure that startups are not naive people. You don't want to be naive about when you see some rich person. Don't be sold to him. He's rich, but you have to understand how he has become rich. So you also look at his background, and he's the right person for you to go to bed with or not. That's all I would say. I would say, you interview the same way they interview you.
Yeah, Dr. Dave, I think Dada mentioned a great point at the end there. It's very important. Look, as an entrepreneur, when you're looking to an investor, understand that, I tell my entrepreneurs, you and I are getting into a marriage because it's going to be a long-term relationship. Okay, trying to grow and build a company and trying to take it to a successful exit, it's not something that happens in 6 months. It doesn't happen in a year. It's not a transaction, it's a relationship. And just like any marriage, you kind of have to make sure that you're in partnership with somebody that's going to be able to support you kind of in the up times and the down times. So what Dada said is basically, look, you need to have somebody, you need to interview them just as much as you're being interviewed. So that's absolutely critical, and it's absolutely right. If you as an entrepreneur feel that the investor is being a jerk, that they don't respect your vision, that they want to see an early exit, they want to return on their money in 5 years, but you want to kind of grow a company over 10 years. If you feel that they're happy getting a 2 times return on their capital, but you want to try to shoot for a 10x return on capital, don't do it. It doesn't matter what the quality of the investor is. It doesn't matter if it's Sequoia India. It doesn't matter if it's Lightspeed India. It doesn't matter who the big brand is. If there is misalignment in interest between you as an entrepreneur and the investor, do not get into that relationship, because that will not end well.
very important advice from you. Thank you. Thank you. So,
Well said.
talking about exit option, how as an investor you look at exit option?
Again, for me, Dr. Dave?
Yeah, that's for you.
So this is where the vulture capital of me comes out. Because again, keep in mind, because I'm an institutional investor, because I have fiduciary responsibilities to the investors that provide money to me, my interests are to generate as big of a profit as I can for the investors that have put money into my fund.
As quickly as you can.
And as quickly as I can, indeed. So that was going to be the second part. First part is get it as big an investment return, and two, get it as quickly as possible. So there's time value to money, and then there's the absolute value to money. Okay. So I am, in this environment that we're in, right? I am very much always calculating, kind of at an individual company level, and overall as a portfolio level, because I'm a portfolio manager. How do I maximize the return for my investors? So I'm always doing the calculation in trying to assess the risk-reward trade-off. When is the right time for me to exit out of that investment opportunity? And as that I alluded to, I'm looking for an investment return as quickly as possible. So if I think that there's a return possibility in 3 years, I'm going to encourage the entrepreneur to get to that exit return in 3 years. If I think it's 5 years, it's going to be 5 years. If it's 12 months, it's 12 months. I invested in an Israeli technology company that was doing, it was an IoT machine learning based technology that did predictive maintenance on motors. Okay. Motors have a rotational speed to them, and you can understand kind of using some machine learning and some data collection techniques and kind of when a potential failure for that rotating component may happen. We were in conversations and trying to raise the next round of financing. And in the process of talking about raising the next round of financing, we were offered for an exit. One of the customers said, hey, look, we want to potentially invest. And as they were doing more diligence, they said, hey, look, we don't want to invest, we want to own you. At that point in time, it was a good exit for us. We ended up getting a 4x return on our capital in 18 months. Mm-hmm. Now, when I made the investment, I wasn't really looking for a 4x investment. I was looking for kind of a 10x return. But because the opportunity presented itself and it was a great exit, and it was a good exit for everybody, the team was motivated. They felt that they themselves would be better aligning themselves with that particular customer, that their potential path to market was better aligned doing it with a partner as opposed to doing it by themselves. We decided to go ahead and take the exit opportunity. So there's no one key metric. It's very much dependent on what the situation is and kind of what the startup is and what the entrepreneur wants to do and what the investor wants to do.
Okay, great advice. Question to Mayank Bhai. Sir, how do you see the team is well balanced, dedicated, and focused on the problem?
This is a very difficult thing to judge all of this in one team at one go.
Right.
What generally is look at what the achievements of the team before they come up with a startup idea, and that you will get some idea about their commitment to the startup. That second, look at the diversity. If let's say 2 or 3 individuals from the same class of technologies course in a university comes with a startup idea, perhaps there is not sufficient diversity. They are just like one person having a technology idea. What generally is can be seen or should be seen is that do they have diverse skills, diverse background, education that can bring different capabilities to the team and that can improve the probability of success for the startup. This is what needs to be seen.
Oh, great. Again, question goes to Ketan Bhai. Why the startup solving this problem? What is your view after you review the innovation?
I'm sorry, can you repeat that question again? So,
after reviewing the innovation or the startup idea, What's your view that why they are solving this problem?
So after I review a particular innovation, kind of, it's dependent on kind of what the innovation is and what the market itself is, right? I would say, look, as an entrepreneur, I don't look at the innovation, right? The innovation is, and by the way, for some of you, here's a really good book that I think everybody should read. It's called The Lean Startup by Eric Reese. Okay, Eric Reese was an entrepreneur in Silicon Valley. He started his own company, had a lot of failures. He actually had 3 different failures before he figured out what the path to success may look like. And it's called Lean Startup. It's a very, very heavily read, very well-influenced book. And the reason why I bring this up is because for every problem that exists, there are multiple different solutions. Okay, so what I look for as an investor is, can you convince me that there is a really significant problem? If you were talking to me about an innovation, know that that particular innovation is just one of multiple different solutions to a specific problem, right? So you may have a fantastic innovation, but there's probably 5 other guys just like you who have a different solution that can address that same problem in equally the same way. So when I look at and I talk to startups, I don't really pay a lot of attention to the innovation. I pay attention to the innovation only to the extent that I need to understand how the innovation addresses the problem at hand. What I really pay attention to is, what is the problem? How big is the problem? What is the scale and the economic opportunity associated with trying to address that problem? Because again, take something that you do on a normal basis. If you want to go to the store to go buy something, you can walk there, you can ride your scooter there, you can ride your bike there, you can take your car there. Just in that simple problem statement of trying to get to the store, there's 4 different options that you can choose from. Mm-hmm. So just like that, in any kind of a technology setting, the innovation in and of itself is not all that.
Then there is Amazon.
And then there's Amazon. Thank you. Yes, that's right. And soon to be GeoMart and Geo and whatever Mukesh Ambani is doing.
Flipkart.
Flipkart. True. My question to the Mayank Bhai. Thank you, Ketan Bhai. My question to the Mayank Bhai is a formal education program with concentration to startup and entrepreneurship is beneficial and need of the hour today?
I believe that in the present curriculum or education system, there is a scope of bringing entrepreneurship related or startup related courses at very early stage. I believe that CBSE has one subject, entrepreneurship, in 11th and 12th that is being offered, but I think it's very dated. It should be updated. At graduate and postgraduate level, I think there has to be a strong element of entrepreneurship or startup related components in overall study program for students, especially for technology students. I think is very important.
Thank you, Mayank Bhai. My question to Ketan Bhai: after investing, what you prefer to act as, mentor, monitor, or director?
All of the above. And I say that because, look, once I make the investment, it becomes kind of all hands on deck, right? My responsibility is multi-party investment. I mean, I talk about the fact that I've got fiduciary responsibility to my investors, but the only way I can fulfill the fiduciary responsibility to my investors is by making sure that the investment is successful. So at that point in time, I am a very hands-on investor. I roll up my sleeves. I act as a coach. I act as a mentor. I act as a sounding board. I definitely, all of the investments that I make, I try to take some sort of a board seat and board responsibility. So I definitely try to have a level of influence or some sort of voice in the direction of the company. But it's all of the above. I mean, at that point in time, when you're negotiating against an investor, it's us against them. You're trying to figure out and trying to carve up the economics between yourself and kind of whoever the investor is. But once you've already gone through that exercise, it becomes a we thing. Because now your success is then tied to my success, and my success is tied to your success. So it's not like, you know, I can't make myself succeed if the entrepreneur isn't going to succeed. So at that point in time, I do everything I can to help them succeed.
True, absolutely. My question to Mayank Bhai, if startup idea has already failed and someone wants to restart with this strategy and process, what's your advice?
Startup idea has already failed.
Yeah.
I think one should first look at the reasons of failure. Can failure be turned around again by different processes? There is an inherent assumption here in this question that all the possible solutions are not worked out. Hence, something has failed and a new solution, a new process is emerging or has been invented, discovered, and the startup idea is tried again. This is a very tricky thing. Generally, it is believed that in startup world, fail fast, learn from your failure, don't fail at the same thing again and again. So I believe this is it's very important to understand the reasons of failure and not to try the same thing again if the reasons are very evident. But if, let's say, some process is not tried, yes, you can try one more time to turn it around.
Okay. Great. Thank you. If someone has a good idea, Mayank Bhai, again questions to you. If innovator has a good idea and wants to bootstrap or get it done from the saving or family funded, what are the areas where one should do a risk analysis before putting the own money?
So one thing, when anybody is coming out with your a startup or entrepreneurial idea, whether it's based on innovation, technology innovation or not, is that be prepared to forego your monthly salary or expectation of monthly salary for at least 3 to 5 years. If you are ready to take this thing, if your family is able to digest this thing, go ahead, do it. But if you are not able to forego the security, safety of salary being credited every month in your bank account, perhaps a startup idea, this is too risky for anyone. This is one thing I would like to advise all of the participants here.
No, thank you. My questions to Ketan Bhai. What should be the approach for fundraising for B2B kind of a startup?
Again, kind of B2B is a broad category. It's kind of it's a market defining category, right? Kind of you have the B2C segment where you're kind of developing some sort of a solution for the consumer market. B2B is effectively trying to go after some sort of the enterprise space. Again, when you say B2B, all business is not created equal. You have kind of the really top end, you have the really large enterprises, the global companies, what in the United States we call the Fortune 100. You kind of have different tiers below that. You have the SMB market, and you kind of have the really small kind of mom and pop shops. So the question here is, what do you define and what do you mean by the B2B space? What segment of the B2B market are you really going after? Mm-hmm. When you go after the really big guys, basically what you're doing is you're going after what I call a whale hunting expedition. These are really big companies, but if you are successful in attracting attention from one or multiple of these really big companies, each of those companies could individually lead to a particular big revenue contract for you. Could be in the millions, tens of millions of dollars. And depending on the technology that you're building, could be even hundreds of millions of dollars. Contrast that to the bottom end of the spectrum where you've got more of the SMB space. SMB stands for small and medium businesses. It's a very distributed market. It's a very fragmented market. There's a lot of these companies. There's a lot of these individual businesses that exist. Let me give you an example. I work out every morning, so gyms, right? So gyms, there's in the United States, in just my local community, there's hundreds of gyms that are available. The challenge there is that, you know, the amount of revenue that you're going to get from them is going to be much smaller, and the ability to attract attention from any one of them is going to be that much more significant and much more difficult to go out and pursue. So you kind of have to look at kind of where you are and try to figure out which spectrum of the B2B space you're really going after, and, you know, how are you positioned to address the needs of those different segments at the end of the day. So look, it still goes back to what I keep saying. It's about the market. What is the problem in the market, and how are you uniquely addressing that particular problem in the market?
True. Another question is, what are the new opportunities overcoming in India after the post-COVID situation and new normal world? Mayank Bhai, if you can highlight certain points here. The opportunities for the innovator in new normal world.
For me, is it?
Yeah.
Okay. There are a lot of opportunities from challenges like COVID-19 emerging. One opportunity is, that was identified is, can we have an alternative to Zoom? Zoom was found to be first Chinese and then US application. It was found to have a lot of data privacy problem. So one opportunity was coming out with an alternative to Zoom for India. If somebody had come out with it, I'm sure it would have become very popular and a lot of money could have been made. Similarly, there can be a lot of opportunities in delivery of food items, delivery of groceries. In fact, many startups which were in some other businesses transferred their activities into deliveries. So delivery has become one opportunity. Third opportunity could be coming out with education technology related startups. Can education be made more interactive, more effective, using without requiring the personal contact? I think these three are tremendous opportunities. Conventionally, the opportunity in the biotechnology area is also huge.
Mm-hmm. Great. Thank you. So the question goes to Ketan Bhai. If the startup is claiming as a platform, it may have a different valuation. If it is calling themselves a fintech solution, maybe venture capitalists look at as a different way of investing into it. And if they call themselves a backbone with the blockchain, the valuation is different. Is it true? And how
Absolutely
it is
true.
Post-COVID?
It is absolutely true that the way you position your company and the value proposition you communicate in the market is going to determine how the market perceives the company. So but please understand that just because you call yourself a platform doesn't necessarily mean that you are a platform. Okay, so there is a platform play. There is an individual software solution play. Okay, or you can call yourself kind of a backbone infrastructure play. But it's not a wordsmithing exercise. It's not an exercise of just basically calling yourself these different things in order to attract the right valuation. What you really have to understand is, do you have the appropriate business, and do you have the business metrics that define a platform versus a solution versus a infrastructure play? Okay, let me give you an example. If you are a blockchain solution, you're trying to find what you're doing is you're basically addressing a finite problem within a specific enterprise or specific application domain. If you're a platform is basically an ecosystem. You have to have the hooks, you have to have the interest, you have to have the tangents that allow you to go out and hook into other parties, third parties that want to interface and interact with whatever it is that you're creating. Okay, if you're an infrastructure play, you're not working at kind of the application layer. You're working kind of at the plumbing layer, effectively, what it's called. Okay, the business metrics associated with each of these different strategies is dramatically different. The business strategy associated with each of these is dramatically different. The economic implications associated with each of these is vastly different. So if you're going out and saying, hey, look, I'm a platform player, but in fact, you're nothing more than just a solution, a point solution, the investor's going to pick up on that. And if there's a disconnect between the two, you're not going to get a lot of investor attention.
Mhm.
So regardless of how you define yourself, you have to really understand how, and do you have a complete story behind how you define yourself? Because that's ultimately what's going to lead to investment success.
Good. Another question to you, Ketan Bhai. What are your views on investing in agri-tech startup?
And I'm sorry, you were cutting out there. What was the question?
What are your views on investing for agri-tech startup?
So there's a lot of attention right now in agricultural technologies. And I think that that's a really, really interesting area, to be honest with you. I think there's a lot of efficiencies to be had. Look, agriculture is, it's a very labor intensive and in a lot of ways, very inefficient market. Using technology to drive efficiencies could be tremendously valuable. And when you talk about ag tech investing could be everything from actually, kind of the stuff that happens on the farm through the entire agricultural supply chain to final production of whatever final good we're talking about here. It could be inclusive of new protein sources, for example. Plant-based protein right now in the United States is very, very hot topic. Replacing other protein sources with more sustainable protein. There's a secondary effect to kind of what's happening in the ag tech space around sustainability and better use of the climate and the impact it has on climate change and such. So I personally, I'm pretty bullish, and I think there's a huge opportunity. But again, it kind of depends on what do you mean by ag tech and where exactly are you going, what problem you're trying to solve.
Mm-hmm. Yeah, thank you. Thank you, sir. My question to Mayank Bhai, if there are some consultant claims that they can help for fundraising, is it a good way to take their paid help? And how many percentage startup take such paid consultancy? You are muted, Mayank Bhai.
I think the question that how many startups take help of paid consultant, no data is available for that. Lot of startup consultants are available for help in assistance in fundraising. I personally believe that a startup should not reach out to them. I think startups should go through the rigor of raising fund on their own. It becomes easy, consultants charge them, the cost of raising fund becomes very high, and they are dependent on consultants, and they don't get the insight which generally is received by interacting with investors in person. So this is my response. I don't think I am encouraging reaching out to consultants for fundraising. In today's world, you can find out the list of venture capitalists in India, list of angel investors in India online. You can mail them directly. They will respond if they like your idea. Why do you need a consultant?
True.
I agree. Who needs a middleman?
True, Dada. So that's all for the day. Moving towards the concluding ceremony of the today's talk on the panel discussion, I thank Mr. Ketan Patel for joining us all the way from USA. Thank you, sir, for sparing your time and guiding, mentoring the innovators in India from all the states. It must be helpful discussion to all the participants, and we have seen a lot of encouragement on asking the questions. They have a lot of queries related learning the investors' mindset, and if so require, I will share certain questions to you over the email so that we can help the participants. I thank Mayank Patel sir for again guiding, mentoring us throughout the session and helping the audience understanding the investors' mindset. And thank you so much, Dada, for joining.
No problem.
And guiding all of us here. You are really a source of inspiration and
Thank you.
media of business and venture fund.
And I want to wish all the entrepreneurs a lot of luck. Continue doing what you're doing. It's a great to be entrepreneur. I have been entrepreneur all my life. Just to work very hard, be honest, try to solve other people's problem, and they will solve your problem in return.
And don't be afraid of venture capitalists.
And don't be afraid of it.
Dr. Dave, thank you so much. This was a lot of fun. I really appreciate it.
Yeah, be careful with them. Interview them just the way they interview you.
Another nice to see you,
Sure,
Mr. Patel. Thank you so much. Have a good evening,
I'm
folks.
sorry that I have let me just share one of my experience. Early on, when I was starting my business, I thought I had a great product, and then I kept going around. I went all the way to Middle East. At that time, these oil people had a lot of money floating around, and so people used to go to them, including Exxon, used to go to them for their startups. And so I thought it was easy money for them because it's oil is free and coming from the their own pressure. So why should these people be so tight with the money? And I found out real quickly that it was pretty scary for me that I'm going to lose my flexibility, my control for a little bit of money. So I said, okay, I told Dadi, we are not going to the store for next 2 years, 3 years. We're going to have to leave hand to the mouth, and let's do it from our own resources. And so that's exactly what I did. And I'm glad that I did that because so until the end of the business, I was owning 85-90% of the business. And but even within the 15%, I made few millionaires in the process, and everybody it was a win-win situation. I don't know how it would have worked out if I had gone for money, but I had a feeling that it would not have worked in my case.
Thank you.
Thank you.
Yeah, thank you, Dada. So,
Bye, everybody.
Yeah, goodbye, sir. Ketan Bhai has to leave. At the end, I would like to thank Akshay Patel for coordinating and arranging everything required to have this panel discussion. Thank you, Akshay.
Thank you, sir.
Professor Remy, thank you so much for helping us coordinating with the panel member and inviting them, especially Mayank. Thank you, ma'am.
Thank you, sir.
Also like to thank Dr. Abhishek Parikh, Dr. Hiren Patel, Dr. Satyen Parikh sir, and Professor Dr. Rajan Purohit sir for joining today's panel discussion and inspiring us. Thank you, everyone.
Thank you, and a happy Janmashtami.
Yeah, Dada. Thank you.
Happy Janmashtami, Dada.
You too.
Thank you,
Yes.
sir.
See you
Bye,
later.
Dada.
We
Bye.
have written our email address in the Q&A. If anybody has any questions related to today's topic to the panel member, please do write to us and we'll get it done with your suitable answer. Thank you everyone for joining. Stay tuned with us. We'll be coming with a lot of other exciting topics.